There's a story about a tightrope walker who crossed a canyon hundreds of times. Crowds came to watch, cameras flashed, people cheered because it looked impossible. What most of them never noticed was the net below the rope. It wasn't glamorous, it didn't make headlines, but it was the reason the walker could keep showing up day after day. Without the net, the performance wouldn't have been braver. It would have been shorter. Here's what's interesting about that. We tend to admire precision and courage. We underestimate the quiet power of having room for error. Money works the same way. Most financial success stories look like tales of intelligence, discipline, or bold decisions. But when you look closer, what separates those who last from those who flame out is rarely brilliance. It's slack, margin, the ability to make mistakes without being wiped out. Room for error is the part of wealth you don't see, and it might be the most important part. I know someone who did everything right on paper. High income, smart investments, aggressive saving early on. Their plan assumed steady markets, stable health, and uninterrupted employment, all reasonable assumptions, until one year they weren't. A layoff arrived during a market downturn. Not catastrophic on its own, but their finances had no breathing room. Every dollar was optimized. Every decision was efficient. There was no slack in the system. The plan didn't fail because it was irrational. It failed because it required life to cooperate. That brings us to the first idea. Financial plans don't break because they're wrong. They break because they're brittle. Here's the paradox. The more optimized your plan is, the more fragile it becomes. In theory, efficiency is good. In practice, efficiency removes buffers. It leaves no space for bad timing, bad luck, or bad moods. And those show up far more often than spreadsheets predict. Historically, this pattern repeats. In the early days of railroads, companies built tracks as cheaply as possible, assuming smooth operations. The first unexpected storms washed them out. The railroads that survived were the ones that overbuilt, spending more than seemed necessary, creating room for error before they knew they needed it. The invisible lesson wasn't about engineering, it was about humility. They admitted they didn't know what would go wrong, only that something eventually would. Money demands the same humility, which leads to the second idea. Survival matters more than optimization. Think about it this way. You don't need the best returns in the world. You need returns that allow you to stay in the game long enough for time to do its work. Compounding doesn't require brilliance. It requires endurance. And endurance requires room for error. Here's where it gets counterintuitive. The safest-looking strategies often carry the most hidden risk because they assume uninterrupted success. The strategies that look conservative often carry the greatest flexibility. I've seen people with modest incomes build enormous resilience simply because their lives weren't stretched thin. Their savings weren't perfectly efficient. Their investments weren't pushed to the limit. They weren't maximizing returns. They were maximizing staying power. The invisible part is optionality. When you have room for error, you have choices. You can wait. You can say no. You can recover. Without it, every decision becomes urgent, and urgency is where mistakes multiply. Nobody's crazy for chasing optimal outcomes. It makes sense. We're wired to want the best. Evolution rewarded efficiency when resources were scarce, but modern financial systems punish fragility more than they reward precision. Which brings us to the third idea. Risk is what happens when plans meet reality. Risk isn't volatility. It isn't numbers on a screen moving around. Risk is the chance that something happens which forces you to change course at the worst possible moment. Here's why this matters psychologically. People don't panic when things go wrong. They panic when they have no margin. A 20% market drop feels different when you have savings and flexibility than when you're leveraged and cornered. Same event. Completely different experience. Historically, you can see this outside of finance too. Early explorers who survived long journeys weren't always the fastest or most confident. They were the ones who carried extra supplies, the ones who assumed maps were wrong, the ones who planned for detours they couldn't imagine yet. Room for error wasn't a weakness, it was their edge. Money rewards the same behavior. Plans that assume imperfection outperform plans that demand perfection. Here's the paradox. Leaving money on the table can be the smartest financial move you ever make. Not because you don't want more, but because the cost of chasing the last dollar is often losing everything you've already built. This is hard because it goes against how success is advertised. We see highlight reels, not safety nets. We see returns, not resilience. We see outcomes, not the room for error that made those outcomes survivable. And yet, the people who last understand something simple. They don't try to predict every risk. They prepare for being wrong. That's the real skill. In the next section, we'll look deeper at why humans systematically underestimate uncertainty, why we build plans that assume stability in an unstable world, and why the most powerful financial advantage is accepting how little control we actually have. For now, hold on to this thought. Wealth isn't about avoiding mistakes, it's about surviving them. And that changes everything. There's a story about a professional poker player who once said the hardest part of the game wasn't learning probabilities, it was learning to survive bad hands without going broke. You could make the right decision and still lose money. You could play perfectly and walk away with nothing. The only unforgivable mistake was betting so much that one unlucky hand ended your career. Poker isn't about winning every hand. It's about staying at the table. Here's what's interesting about that. Most people understand this idea in games. They struggle to apply it to money. This brings us to the fourth idea. Humans are wired to underestimate uncertainty, even when we know it exists. Psychologically, we crave narratives where outcomes make sense. We want success to be earned and failure to be explained. Randomness makes us uncomfortable, so we downplay it. We replace uncertainty with confidence. We convince ourselves that the future will behave like the recent past. That instinct made sense evolutionarily. If you assume tomorrow would look like yesterday, you conserve mental energy. You didn't need to reevaluate everything constantly. But in modern financial systems, this instinct quietly works against us. Think about careers. I know someone who built their life around a single employer, not because they were naive, but because it worked. Promotions came regularly, raises were predictable, stability felt permanent. Planning without a backup didn't feel reckless, it felt rational, until the industry changed. Not overnight, gradually. Then suddenly. The problem wasn't a lack of talent or effort. The problem was that the plan had no margin for a future that looked different from the past. Here's the paradox. The longer things go right, the more confident we become that they always will. Historically, this shows up everywhere. In the early days of commercial aviation, pilots flew by visual cues. It worked most of the time. But when weather changed unexpectedly, disorientation set in. Crashes followed. The solution wasn't better eyesight. It was accepting uncertainty and building systems that assumed pilots would sometimes be wrong. Room for error saved lives. Money works the same way, which leads to the fifth idea. The biggest risk is not realizing how close you are to the edge. When things are going well, risk feels abstract. Loss feels theoretical. That's when people stretch. They borrow more, they commit more, they reduce buffers because unused margin feels wasteful. Nobody's crazy for doing this. It's human nature. When the road is smooth, guardrails look unnecessary. But here's where it gets counterintuitive. Risk doesn't announce itself when it's growing. It only becomes obvious when it's already too late. The invisible part is proximity. How close are you to a forced decision? I've seen families with high incomes and impressive lifestyles who were one missed paycheck away from chaos. And I've seen people with modest means who could absorb multiple shocks without panic. The difference wasn't intelligence, it was margin. Room for error turns financial shocks into inconveniences instead of catastrophes. Historically, this idea predates modern finance. Ancient farmers stored surplus grain not because they expected famine every year, but because they knew bad seasons were inevitable. The surplus wasn't efficient, it was life-saving. Modern finance often forgets this lesson. We design systems to work beautifully in ideal conditions. Then, we're surprised when they collapse under stress. Here's the paradox. The systems that look wasteful in good times are the ones that survive bad times. Psychologically, this is hard because we're judged on visible performance. People admire growth, not resilience. They praise returns, not buffers. They reward confidence, not caution. Room for error doesn't look impressive. It looks like missed opportunity until it saves you. This connects to something deeper. The sixth idea is that stress changes behavior far more than we expect. Most financial plans assume rational behavior under pressure. That's the flaw. When people feel cornered, they don't calmly optimize. They react, they panic, they sell at the wrong time, they double down when they shouldn't. They abandon long-term plans for short-term relief. This isn't a character flaw, it's biology. Under stress, the brain prioritizes survival over strategy. Short-term certainty feels safer than long-term logic. Room for error reduces stress. Reduced stress leads to better decisions. That's the loop most people miss. Here's what nobody talks about. Margin isn't just financial, it's emotional. When you know you can afford to be wrong, you behave differently. You're patient, you're flexible, you're less reactive. You don't need to be perfect. Think about it this way. A bridge isn't designed to hold exactly the weight it expects. It's designed to hold much more, not because engineers are pessimistic, but because they're realistic. Life adds weight you can't predict. Money should be built the same way. The people who succeed long-term aren't the ones who avoid mistakes. They're the ones whose mistakes don't end the game. That's the psychological advantage of room for error. It creates distance between problems and decisions, and that distance is where wisdom lives. In the final section, we'll tie this all together. We'll look at why room for error isn't about fear, why it actually creates freedom, and why the most powerful financial strategy isn't maximizing outcomes. It's maximizing survivability. Because in the end, the goal isn't to be flawless. It's to last. There's a story about a mountaineer who was asked why experienced climbers move slower than beginners. The beginner wants to reach the summit. The expert wants to come home. Both want success. Only one plans for failure. That difference captures the seventh and final idea. Room for error isn't about pessimism. It's about survival being the prerequisite for success. Here's what's interesting about that. Most people think financial success comes from boldness, big moves, big bets, big confidence. But when you look closely at long-term outcomes, success is usually quieter. It's not the person who makes the most dramatic decisions. It's the one who never gets wiped out. Here's the paradox. The best way to grow is to focus on not shrinking. This idea shows up everywhere once you notice it. In health, the people who live longest aren't those chasing extreme fitness goals. They're the ones avoiding the obvious killers. In relationships, the strongest marriages aren't the most passionate. They're the ones resilient to stress. In careers, longevity beats brilliance. Money follows the same rule. The invisible part is optionality. Room for error gives you choices. And choice is a form of power most people underestimate. Think about someone with enough savings to say no to a bad job, or enough flexibility to walk away from a toxic business deal, or enough slack to wait instead of rushing into the wrong decision. That's not laziness, that's leverage. Here's where it gets counterintuitive. The more room for error you have, the less you need luck. People often credit success to being in the right place at the right time, but what allowed them to benefit from that moment was survival beforehand. You can't take advantage of opportunity if you're forced to recover from disaster. Historically, this shows up in generational wealth. Families who keep wealth over decades aren't those chasing maximum returns. They're the ones avoiding irreversible losses. They value durability over dominance. The mindset is subtle. It doesn't ask, how much can I make? It asks, what could ruin me? Nobody's crazy for ignoring that question. It's uncomfortable. It forces you to imagine failure. But avoiding the thought doesn't avoid the risk. Here's the psychological shift that changes everything. Once you accept that uncertainty is permanent, margin stops feeling like a cost and starts feeling like freedom. Room for error lets you sleep at night. It lets you think clearly. It lets you stay calm when others panic. And calm is contagious, especially to yourself. Think about it this way. A person who doesn't need immediate results can make better long-term decisions. They don't chase trends. They don't react to noise. They don't confuse activity with progress. That's not because they're smarter. It's because they're smarter. It's because they're safer. Here's another paradox. The people who can afford to take risks are often the ones who take the fewest. Why? Because they don't need to prove anything. They're not desperate. They're not cornered. They're not trying to catch up. They already have margin. That margin changes behavior in ways spreadsheets can't capture. This brings us back to the opening idea. Financial success isn't about predicting the future. It's about being prepared for futures you can't predict. Room for error acknowledges a simple truth. You will be wrong sometimes. Markets will surprise you. Life will interrupt your plans. Your emotions will override your logic. The goal isn't to eliminate these realities. It's to survive them. Knowing this doesn't magically make decisions easy. You'll still feel the pull of greed when things go well. You'll still feel fear when they don't. I struggle with this too. Everyone does. But room for error gives you time. And time is the most underappreciated asset in finance. Time lets compounding work. Time lets mistakes heal. Time lets patience pay off. Without room for error, time becomes your enemy. Every setback feels urgent. Every decision feels final. With room for error, time becomes your ally. Let's come full circle. The most impressive financial stories aren't about people who are always right. They're about people who were never forced out of the game. They didn't avoid risk. They respected it. They didn't seek perfection. They built resilience. They understood that the most important skill in money isn't forecasting, it's endurance. So the real question isn't how confident you are in your plan. It's how much room you've given yourself to be wrong. Because in a world that's always uncertain, the ability to absorb mistakes isn't a weakness, it's the edge. If this changed how you see money, hold on to that idea, not as a rule, but as a lens. A way of thinking that prioritizes survival over optimization. In the long run, the people who last are the ones who leave themselves space. And space, more than intelligence or income, is what turns financial decisions into financial success.